My name's Ross McFerrin. I'm the Vice President of Enterprise Growth here at Trustly. It's interesting because consumers still carry cash. Some use it to budget. Some use it just because they want to make sure that they've got the ability to spend wherever they are. It's not accepted for everything. You're not going to pay your mortgage with cash. A lot of merchants have stopped accepting cash. I think every airline, I believe, has shifted to cashless as well. So you're seeing more and more often you can't use cash where you want to or where you're used to. But at the same time, merchants are still looking to embrace it. They're realizing that the cost of payment acceptance is really high. You see a lot of restaurants that offer either a discount or they surcharge on card, but if you pay with cash, you're not paying that 3% surcharge or whatever it is that they're charging. It's still certainly relevant, and it's great for certain payments, but you can't use it everywhere. Consumers are going to benefit by using cash because there's no interest. It's all instant settlement. Your payment is final, but the big risk, it's not the safest. There's no paper trail, so if your cash is stolen, good luck recovering it. Seems like everybody uses a card. Virtually every merchant, every restaurant, every merchant that you go to online and in store, they all take cards. So from that aspect, it's convenient. And it puts spending power in your pocket without having to worry about carrying around a big wad of cash. So I use cards because I'm a big rewards junkie. I like the airline points that I accrue. I like the cash back. I think that's why a lot of consumers prefer a credit card. It also offers some protections that other payment methods don't. So there is a lot to like about card, but maybe more so credit card than debit card. I feel like debit card, of all of the payment methods out there, is maybe the weakest, just because you don't get anything outside of converting your cash into a plastic. There's nothing that you're really getting out of it. So it is convenient, but you're not getting any cash back. You're not getting any rewards, no airline points, but the banks are making money off of your spend. So where's my piece? I want some of that. So that to me, for consumers using credit card is certainly the superior of the two. So many merchants are just scraping by with very low margin, so the only way that they can ensure profitability is by surcharging to avoid the high cost of payment acceptance, or at least to supplement it or subsidize it. So with that, I'm seeing it more and more often, where it's typically restaurants, some gas stations as well, but lots of merchants are surcharging or charging 2%, 3% if you use your credit card, or nothing if you use a debit card or cash. And you even see it when you're paying bills. So there are a lot of billers leverage electronic bill payment presentment platforms. And those companies' money is usually made when they're charging a convenience fee or a consumer fee for use of card, but then they'll give away ACH for free. So consumers are becoming used to having to pay fees when they use a card. Sometimes it's not always transparent. So I'll get a bill, I'll pay, but then don't realize that I have another 3% thrown on top until I get the signature page back. And it's a little bit irritating to me. And I don't know how many consumers actually pay that close attention, but it's happening constantly. BNPL's gotten very popular. You saw it soar right around COVID. We saw all the major players really take off. And what merchants like about BNPL is they're expecting top-line revenue. They're bringing in new consumers that may not be able to afford a product today, but they're still buying it, and the merchant is getting funded, irrespective of what happens on the repayment to the buy now pay later provider. Consumers like it because it gives them increased spending power. Either can't or don't want to afford something today, don't want to pay for it today. So let's break it up into chunks and make budgeting a little bit easier for me. What I don't like about it is the potential to put somebody into a revolving or a spiraling debt situation. So for that reason, I would never use buy now pay later with installments in grocery. I would never use it to fill up my tank. I would never use it for those everyday spend categories where consumers are making these purchases, some daily, some weekly, monthly, and when those installments begin to pile up, suddenly that consumer is paying so much more than they had been just because they tried to defer or get by for a week or two. I think there's plenty of value in buy now pay later when you're looking at fashion, when you're looking at electronics, when you're looking at one-time purchase, but certainly not repeat. I think the industry is really paying attention to pay by bank right now. And what I really like about it is when you look at the demographics that have an interest in pay by bank, it really leans in on the debit consumer who isn't getting anything today by using their debit card, and it pulls away some from buy now pay later as well. And I can touch on both. But so first, merchants like pay by bank because it's less expensive. far less expensive than credit, debit, buy now, pay later, and also far less expensive than cash because there's a high cost to handle cash. So when you look at the cost, it offers then the merchant opportunities to double down on the value that they're providing to the end user, to the consumer. So if I'm a grocer and my rewards program generates fuel points for my customers so then they can go to a gas station and fill up a tank at a discount, maybe I want to invest more heavily in fuel points for that customer that's using their bank account instead of using their credit card. And now, maybe me as the consumer, I'm incentivized not only to use my bank and save the merchant money, but I may spend more because I want more fuel points. So the merchant wins, the consumer wins. What I also like about it is it offers more flexibility than debit card. So while debit may decline you because you don't have money in your account today, what we can offer is higher approval rates because we're looking into the account and anticipating balance, not just going off of a current balance. So if we see that you get paid tomorrow, we may approve that transaction knowing you're good for the money. Or even better, offering you more flexibility in when you want that payment to come out of your account. There's so much that open banking unlocks for a pay-by-bank use case, and there's a lot that can be poured back into the consumer in terms of value. It's not nearly as adopted as it will be, but just based on all of the merchant engagement that we're having right now, based on the trends that we're seeing in the industry, it's going to be. Absolutely. And I think most so in everyday spend categories. That seems to be where the pay-by-bank value proposition resonates the strongest because many of those industries are incredibly thin margin, highly competitive. And when you layer on top the cost of payment acceptance, it makes it very, very difficult for the business. So the more that they can pour into a low-cost method of payment, the bigger their margins become. I think what a lot of providers are experiencing is ACH risk management is really hard. We're seeing a lot of companies pull back from e-commerce, from retail, because it's very difficult to manage ACH risk. We, on the other hand, have a huge amount of experience here. So while others are pulling back, we're leaning in, we're seeing an opportunity, and we're embracing it. What we're seeing is there are other providers out there who have found it so difficult to manage ACH risk to where they're just clamping down hard on their approval rates. So, you can offer a killer price for pay by bank, but if you're only approving 50% of the traffic, you're just killing the business and you're killing the merchant that you're there to serve. That's one way to do it. That's not the way that we do it. So different ways to pay with a card, like Paze. I continue to struggle with what the real compelling value proposition is with Paze, because all it is just a different way to, your credential-based paying with a credit card rather than keying in your 16-digit PAN. But in most cases, consumers already have their credit card details saved to their device. So it's a little confusing to me as to why I would need to go through a Paze experience if I've already got my information on my phone or on my computer. For Pay by Bank is an opportunity for much higher approval rates than other payment instruments. So not only is it secure and not only is it instant, but merchants and consumers both are going to see high approval rates because these are bank accounts that don't expire. Consumers on average keep that account for 17 years, whereas with cards, you're seeing an expiration of anywhere from 3 to 5 years. There's an embedded churn event and a lot of false positives. I would maybe just emphasize with Pay by Bank, there's a more secure way to see high approval rates for the consumer, ultimately benefiting the merchant's top line, great customer experience.